Hello, everyone, and welcome to today's FICO webinar, Score a Better Future National Home Ownership Month. Today's session is being recorded, and you are currently in a listen-only mode. You may type in your questions to the panelists at any time in the Q&A panel at the bottom of your screen. Simply click on the Q&A icon to open up that panel, type in your questions, and then click on the Submit button to get your questions into the queue. We will also be taking your feedback on a few polling questions today. During that time, the polling window will pop up in the center of your screen. Just click on the circle or square that corresponds to your answer and then click on Submit. Finally, if you experience any technical difficulties during today's webinar, please chat your host in the chat panel. You can find that chat panel icon at the bottom of your Zoom webinar screen. All right, once again, at this time, let's begin today's FICO webinar, Score a Better Future, National Home Ownership Month. It is my pleasure to introduce your host, Keon Haley, Program Director for Score a Better Future. Keon, you have the floor.
Hey, thanks, Jessica. And good day, everyone. Thanks for joining us for our Score a Better Future Credit Education webinar. As Jessica said, I'm Keon Haley. I am the Program Director for Score a Better Future. And I'll be your host for tonight's webinar. We are hosting this webinar in honor of National Home Ownership Month. And so for many, a home is more than just a residence. It is a place that instills a sense of pride, security, and comfort that no matter what challenges in life arise, we have somewhere to go and call our own. This is the power of home ownership. It is also a major source of generational wealth for many consumers and is the central part of the American dream. We are here today to do our part to help you obtain that dream by providing you with information you need to know about credit scoring, and how it plays a role in the home buying process. During today's webinar, you will hear from FICO Score expert Tom Quinn, who will be sharing important information about credit reports, your FICO scores, and where you can obtain those items and why they're so important to monitor, especially when you're searching for a home. You will also have the opportunity to meet with financial well-being coaches from Operation Hope, who can help you start down the path of home ownership and start a plan to get you on your way to crushing your financial goals. So you will hear more about those opportunities later in the session when Operation Hope representative Yolanda Butler provides some additional information about Operation Hope and the programs they offer. If you have any questions while we're going through the presentation, as Jessica mentioned, please ask them in the Q&A. We have Operation Hope coaches standing by to answer your questions there. And we'll also take some of those less personal questions and have those answered live later in the session. I would like to also thank our wonderful partners who have helped us promote and put this webinar together. All of your hard work is really appreciated, and we greatly appreciate your partnership. And so without further ado, here's the man of the hour, Vice President of Scores, Tom Quinn.
Thanks for the introduction, Keelan, and welcome everybody to today's session. We're really excited to be here, and we'd like to kick it off with just a quick polling exercise to get a foundation of what everyone knows about scores already. So if you can take a few moments, the screen's popped up, you should be able to answer the questions. As a side note, no need to take notes or whatnot. We'll be able to get you a copy of the PowerPoint after the session's over. So you can just focus on listening and seeing and learning. So the questions here are true or false. So the first one is missing a few payments now and then is okay and won't have much of an impact on your score. Is that true or false? A hard inquiry could lower your FICO score is the second question. Is annual household income a part of the calculation of a FICO score? Is closing unused credit card accounts a good idea as a means to increase your score? And then lastly, the reporting of a credit account in forbearance or deferred payment plan is considered negative by a score. So these are some of the common questions we get from consumers. And so we have packaged them up and would love to see what the audience here knows. So let's go over these. Thank you, Jessica, for popping that up. So about 30% of you felt that missing a few payments now and then is okay and won't hurt your score. Actually, the opposite is true, that missing a single payment is enough to have a substantial impact on score. So paying your bills on time is the #1 action you can undertake to manage your FICO scores and get them increased over time. A hard inquiry could lower your score. Everyone got that one right. So with inquiries, there are 2 types. There are hard inquiries. So this is when you would go to a car dealership today, for example, and apply for financing for the car. They're going to pull your credit report on you, and that's considered a hard inquiry. If you get a pre-approved credit offer in the mail, they may have used your score to pre-approve you for that. That won't count. But if you respond to the pre-approved offer and they pull a credit report on you, that is considered a hard inquiry. So hard inquiry is basically anytime you're seeking credit proactively. And the opposite of that is a soft inquiry. And a soft inquiry would be, for example, when you pull your own credit report to see your score and credit report, that's considered soft and it's not counted against you. The third question, annual household income is a part of the calculation to score. Most people said that that was true, and that's actually false. Income is an important data element that lenders will ask for and use in their assessment of your application for credit, but it is not considered in the FICO score. And the main reason is because it's not verified to be accurate, and so it is not used for that reason. The next question was, is it a good idea to close unused credit card accounts? And the answer on that is no. Closing unused credit card accounts will not help your FICO score and could actually hurt it. And we'll talk more about that later in the presentation. And then the last question was, is the reporting of a credit account in forbearance or deferred payment considered negative by the score? And the answer is no. The fact that you're in forbearance or a deferred payment plan of it, the flag of that is not considered negative. But how your credit is managed after that could have an impact on your score. So we'll talk about that a little bit later. So good job. A lot of you are already credit score knowledgeable. That's excellent. So hopefully we'll be able to add to that knowledge level for the rest of the session. So I'll close that out. So what are we going to talk about today? The first section is we're going to do a credit score system overview, just to make sure everybody's on the same page of how the system works and who are the players. Then we'll go over the FICO score dynamics. I mean, the overview of the FICO scores in terms of how they're built, what they're looking for, how you can manage yours better. Then we'll talk a little bit about FICO score dynamics, and then we'll finish it up with a section about protecting your credit. And then we'll have the Operation Help folks join us in helping you understand the services that they provide. So there's a lot of different players in the credit ecosystem space, and they all have different roles and have different features that you need to be aware of as you're thinking about your credit empowerment situation. So obviously there's you, me, everybody here, the consumer. Lenders want us to apply for credit and loans from them. They also want us to pay on time and avoid things like bankruptcy and collections. And they want us to utilize our available credit with them. That's how they make money. So you as a consumer have access to your credit report and FICO scores through a number of different channels. So you are in control of your destiny in terms of your credit rating, as well as the ability to play in the marketplace to get credit from different lenders. Then we have the lenders. They are in the business to grant credit and loans to you. They pull your report when you apply for credit to understand how you've been managing your credit to date and use that information in the risk assessment. They also report your information to the Bureau in terms of how you've been paying your bills as agreed or not, or if you had any late payments. And they also are a source for you, the consumer, to get access to your FICO scores through a program called Open Access. And we'll talk about that in a little bit. Then we have the credit bureaus. In the United States, there's three main national credit bureaus: Equifax, Experian, and TransUnion. And they create and update your credit report profile with information provided by lenders as well as the court system. They house the FICO Score algorithm that calculates your FICO score and appends it to the credit report for you to see or a lender to see. And they also make credit reports available to you to make sure that you can ensure that the information being reported on you is accurate. And then the last player, but not the least, is FICO. And many consumers consider us or confuse us to be a credit bureau. So we do not have access to any credit bureau information on you. What we do is we build the FICO Score mathematical formulas that generate the score. And so that software that calculates the score is programmed at the credit bureaus. And whenever a lender or someone requests your FICO score, it's passed through that algorithm at the bureau, and it's never that information is never provided to FICO. And FICO has lots of information and focus on education and helping consumers understand scores. Obviously, this seminar is one of those. And we have abilities to provide consumers with their FICO score through a variety of programs, including myfico.com, as well as open access. So this web of entities and flow of data are basically the infrastructure of how it all connects. A time for another polling question. So where have you recently obtained your FICO score? And you can check more than one that apply in your situation. So if you think of the last 3 months or so, where you were able to get access to your score, was it with an online statement with one of your lenders or credit card issuers, at creditkarma.com, at TransUnion, at myfico.com, at Experian, or you have not recently obtained your score? So to give you a few minutes to think about that and answer the questions. All right, thanks, Jessica. So a large percent of you, over 50%, are able to have indicated you've gotten your FICO score in your online statement. So FICO does have a program called Open Access, and it basically enables lenders such as credit card issuers, Citibank, Wells Fargo, et cetera, other big institutions, as well as small institutions and credit unions, the ability to provide you access to your FICO score that they pooled for mostly account management purposes. And with that information, you also get access to your top reasons why the score is not higher. So I'm glad that a lot of you are able to take advantage of that. At Credit Karma, about 20% of you indicated you got your FICO score from Credit Karma or TransUnion. So these are two entities that do provide access to credit scoring solutions on their consumer-facing websites, but they're not FICO scores. They're different brands of scores. A small percent of you have gotten it at MyFICO, at Experian, about 30%. And Experian is a distributor of FICO scores. So when you go to Experian.com, you are getting access to the FICO score. And about 25% of you have not recently obtained your FICO score. And so hopefully that's something that will remediate today when you have the opportunity to work with the counselors and get access to your score. Thank you. So in the previous polling question, you saw that some people had indicated they thought they were getting their FICO score, when in reality, it was not a FICO score, it was a different branded score. So I sometimes get consumer complaint calls sent to me, and I had one several weeks ago where the consumer was frustrated that they had planned on going to they had visited a car dealership over the weekend to purchase a car, and they needed financing to get the car, and they had done their homework, and they had went to a site and got access to their credit score that said that they were in the low 700s. So they knew that the low 700s, while is a decent score, most lenders would consider that, a good score. They were confident when they walked into the finance arm of the dealership that they would, have a good experience. However, when the finance dealer actually entered their information and pulled the score from the system that he was using, it ended up being the score was in the upper 600s. And so this put them in a higher interest rate tier, and they were frustrated because they even had printouts of their score that they had obtained in one of these other sites. And the car dealership informed them that, he's pulling a FICO score, and the score that they pulled on their Credit Karma site was not a FICO score. So it's important to understand that there are different credit scorings out there, and that can cause confusion. And you want to make sure that when you're looking at a score, especially if you're thinking about getting finance, you want to get a version of the score that's being used in credit decisioning. And FICO scores are more likely to be used by lenders than other versions of the score. So it's in your best interest to try to make sure you find a FICO score to be tracking to. And so we have logic and rules in place with our distributors that they always have to reference it as a FICO score when they're presenting it to you in this on the online environment or in a paper display. So if it doesn't say FICO, it's most likely not a FICO score. So don't be led into that confusion like the gentleman that I was talking to a couple of weeks ago. So where can you get your FICO score? There's a variety of different places. So we already talked about the FICO Score Open Access Program. We also have FICO scores available at myfico.com for any consumer to go out and sign up for those products that have that. And Experian.com. So Experian is one of the three major bureaus, and they offer exclusively FICO scores in their solutions. And so the next logical question I usually get is, where can I get my FICO score for free? Because we all like free stuff. And you can get your score for free at Experian.com as well as myfico.com. So there's plenty of opportunities for you to see how lenders see you and get access to the score that's being used for credit decisioning. Again, just make sure you check if it doesn't say FICO score, it's most likely not a FICO score. So that was to give everybody a quick overview of the credit system and how it works and the players involved. Next, we'll go diving into how FICO scores are built, what they're looking at, and how you can manage them over time. So the FICO score is calculated on the information in your credit report. So it makes it important that you understand kind of what is in your credit report and what could be eligible to be influencing your score. So in this example of a sample credit report, we kind of break it into what we call information zones. And the first information zone is your personal identification information. So here we're looking at the information captured here would be your social security number, your date of birth, your street address. Sometimes they do have employment information listed and income information listed. Typically, that's not verified information, and it could be out of date or not even relevant. I know on my own credit report, my employment listed an employer that I had over 20 years ago. So it's true I did work there, but it's been a long time. So the information here is used to match and find your credit report file in the credit report database, but it's not used in calculation of the score. Then we have public records section. So the credit reporting agencies, have links into the public records system of courthouses across the country. And if there's a notice of bankruptcy filing in your name, then that would populate on the credit report and be considered in the score. And obviously a bankruptcy is not a good thing, and it's going to hurt your score significantly. They also report third-party collections. So this is typically a scenario where if you are late on a credit card and you don't pay in 30 days, 60 days, 90 days, 120 days, 150 days, 180 days, so 6 months, typically the lending institution will sell your account to a collection agency, and the collections agency will try to collect on that money owed. And so that's information that's reported to the Bureau, and it's considered negative by the score. The fourth category or information zone is trade lines or account information. And this is where a lot of the meat of the score is generated from, because there's a lot of information here. So you can see we have listed here a bank card, which is a fancy name for a credit card. And we would have information about when it was opened, when it was last recorded on, what is the credit limit available on that revolving trade line, the balance, your current status, if it's paid as agreed or not, and if it has any historical delinquency. So we collect that information on revolving trades like credit card, as well as auto loans and mortgages and retail, et cetera. And as I said before, that's what's really driving the score for most individuals, is the information in that section. And then the last category is inquiries. We talked about that a little bit in the beginning, but basically inquiries are reported on your credit report for up to 2 years, and then they fall off the credit report. And FICO scores look at inquiries that were posted in the last 12 months. So we're not, if it's greater than 12 months old, it's not being considered by the score. Inquiries generate a lot of questions and a lot of people focus on them, but in reality, they generate relatively few negative points on your score. So the real focus should be on paying the bills and keeping the balances low and not worrying about the impact of an inquiry on your credit score. So the credit report has these information zones and all this data in it. So what is a FICO score? And a FICO score is basically a 3-digit number ranging from 300 to 850 or higher is better that lenders use to make better credit decisions on whether they're going to grant you credit, as well as the terms associated with that credit, the credit line and the APR. So if you think about a lender having to look at 100 applications and the average number of credit trade lines reported on the credit report is 14, looking at the 100 applications manually versus having a score on them that has a predictive probability of the consumer paying as agreed or not, it makes it much more efficient and fast and accurate to use scoring than compared to using judgmental review of a credit report in your decision process. So that's why lenders like scores. While the U.S. consumer is a pretty credit-hungry consumer, we rely on credit a lot in terms of funding our lifestyles and buying a car, getting a home with a mortgage, going to university with student loans, and then using credit cards for paying of goods and services. So most U.S. consumers 18 years old or have a credit score and a credit report, but not everybody does. And there's a minimum requirement we have to meet that in order to generate a score on a credit file. So first of all, we will not score a file if it has a deceased indicator on the credit report. So that's something that I don't think anyone would find controversy with. And then it requires at least one credit account to have been opened in the last 6 months. Have been open for 6 months or greater, and one credit trade line that has been updated or reported on in the last 6 months. So you could be a consumer that had opened up a Target credit card 7 months ago, and you've used it 3 months ago. So it would be older than 6 months, and your date updated, most recent update was 3 months. That's enough information on that relatively small bit of information for us to generate a score that a lender could use in the credit decisioning process. As I indicated, most people have credit score and credit report, but if you don't, there's ways you can go about getting into the system. And there's a little bit of catch-22 that people feel that in order to get credit, you have to have credit, and there is some truth to that. But if you are a consumer who doesn't have a FICO score yet and you're 18 years or older, some ideas you could explore would be to see if you could be put on as an authorized user on a credit card account of a family member. And basically that allows the primary user of the credit card for that account information to be reported under your name at the credit bureau as well. And so you get the benefit of having a credit established through that authorized user relationship. You could sign up for a secured card with your credit union. And so basically the way those work at a high level is you sign up for a secure card of $500 by putting down $500 as a guarantee against that. And then you use that credit card like a normal credit card, and it's reported to the bureau like a normal credit card. There's no indication that it's secured. And you would, as long as that secure card is at least 6 months old and has been updated in the last 6 months, it would be enough to generate a score. So there are different options available if you happen to be someone who's new to credit or perhaps recently immigrated to the country and don't have a established report yet to get those established and get access to credit and other services by having a robust credit file. We have another polling question here, Jessica, and this one is, what information is considered in a FICO score? And check all that apply, so there can be more than one answer. So does the FICO score consider employment status, the date an auto loan was open, credit card balances, zip code, bounce checks, or none of the above? We'll give folks a minute to think through those and answer the question. Jessica, are we ready to show the results? All right, employment status. Actually, employment status is not considered in the calculation of a FICO score. Again, it could be, you could see your employer listed on the credit report in that first information zone, but it's not verified, and so the score does not consider that. Again, a lender may ask for that information in the application and use it in their credit decisioning process, but it's not part of the score. The date that an auto loan was open is obviously included in the score. Everyone got that one right. Credit card balances, same thing. No big surprise there. Zip code is not considered in the calculation of the score. So whether you live in Beverly Hills or a rural town in Kentucky, it doesn't matter. The zip code is not considered in that score calculation. And bounce checks, this one's a little bit of a trick question or answer. So obviously most of us would agree that having a bounce check is a negative sign and indicative of potential risk there if someone recently bounced a check. However, checking account performance is not reported to the three big credit reporting agencies. So it's not considered part of the FICO score because it's not, that data is not available. But there are other entities out there that track bounce check behavior, and a bank may use that in addition to a FICO score when they're making credit decisions if they have access to that information. So good job on those. So in summary, the things that are considered: your trade line or your credit accounts, credit inquiries, hard ones, collections, third-party collections, and public records, meaning bankruptcies. What's not considered is how old you are, where you live, what type of employment you have, how much money you make, your race, your gender, etc. So we're really looking at the raw credit information in your credit report to come up with a score that's predicting whether you can pay your bills or not in the future successfully. So what makes up the calculation of FICO score? So we saw the information zones in the credit report. So when we build a FICO score, we're looking at basically 5 predictive categories of information. The first is payment history, which represents 35% of your score. Your outstanding credit debt represents about 30% of your score. How long you've had credit history represents about 15% of your score. Actually, activities related to pursuit of new credit has about 10% of your score, and credit mix represents another 10% of your score. So you can see in this pie chart, if you had to focus on one thing to improve your score or maintain a good score, what's going to have the greatest contribution to that? And that's payment history, so making your payments on time. And then the second one is outstanding debt owed. So managing reasonable amounts of debt owed and making payments on time, that reflects about 65% of your score. So those are areas that you'd want to focus on. So what are we looking at when we're building the score in relation to these predictive characteristics or categories? So it's kind of no different than, let's say you later this evening get a call from your friend, cousin, brother, relative, etc., and they said, "Hey, can I borrow $200 from you?" So if that were to happen to you, what are some questions that are going to come up in your mind regarding that request? So one question may be, have I lent this kind of money to my brother before, and has he paid me back, or has he never paid me back? Has my brother borrowed money from my mother and my other brother and my sister, and did he pay them back on time? So knowing that information and behavior traits, not just with me, but with other members of my family. What's he want to use it for? Is it, to pay rent, or is it to go buy an airline ticket? So, just general questions you would think about before you would give your money to your relative asking for it. The FICO score is doing the same thing. It's asking a series of questions about the credit report and getting an answer, and then we mathematically and statistically assign a point value to that information to come up with the score. So let's go in a little bit more depth and see what we're looking at. So payment history is all about, are you making payments as agreed and on time with your debt that you owe? So when we look at delinquency, we look at it in 3 main ways. We look at it in terms of how recent it was, how severe it was, and how frequent it was. So recency is really important. If you have missed a payment recently, like in the last 12 months, for example, that's going to have a much harder hit on the score than if you had a blemish or a missed payment that happened, let's say, 5 or 6 years ago, because it's showing recent behavior, and the model's really looking at the recent behavior to come up with, are they going to pay as agreed, tomorrow when you extend this credit to them? The second would be severe. So, did you have a late payment on your report that was just a 30-day late that happened 2 years ago? you were on vacation, you forgot to pay a bill, or just something happened and there's just it only went one cycle past due. So again, here, if you're more severe, like you're not 30 days past due, but you're 120 days past due, that's more than just the dog ate my bill or I forgot to pay it, because you've shown 4 months consecutively that you missed payments. So the more severe it is, the harder hit it's going to have on your score. And then the frequency. So is this a one-time random occurrence of a missed payment on your whole credit history? Or are we seeing a pattern of missed payments, last month, the month before, 5 months ago, 12 months ago, etc.? So with payment history, again, we're looking at how recent it is. And the more recent it is, the more it's going to hurt. How severe it is, the more severe it is, the harder it's going to hit. And how many do you have? Is there a lot there? And I've seen credit reports where you look at them side by side and they're similar, not the same, but they're similar. And the person who had let's say, a more severe delinquent, 90 days, has a better score than someone who only has a 30-day. But that 30-day was posted last month, whereas the 90-day was posted 5 months ago. So it's not all doom and gloom for payment history. The good news is the scores are flexible and forgiving. So as this delinquency information ages on your credit report, it has less and less an impact on your score as your new behaviors are showing good payment as agreed. So delinquency information is required by law to be purged from your credit report after 7 years. So if you had a bankruptcy that occurred in 2009, it would not be considered in the score today because it would not be on your report. There's no way we would know that happened. And the other information here is that as it ages, it has less impact on the score. So it's not all doom and gloom if you have a current score that's not as high as you want, or if the credit obligation delinquencies. Again, as they age, they have less impact on your score. So the second consideration is what we call outstanding debt or amounts owed. So this is looking at your credit amounts owed reported to the Bureau. So what are the balances reported on your credit cards? What are the balances owed on your installment loans, like a student loan, a personal loan, or a mortgage, or a car loan? And so we're looking not only at your use of those in terms of balances, but more importantly, how much of your credit is being used. It's called a utilization percentage. So how do we calculate that? So let's say you have 2 credit cards and each credit card has a $5,000 line available to you. So that means you have $10,000 available credit to you. And then on each card, you have a $2,500 balance. So then we take the $2,500 balance divided by the $5,000 line to get a utilization calculation of 50%. So you're using 50% of that $5,000 line. What the model tells us and the data tells us is the more of your available credit that you're using, so if your utilization percent is 70%, 80%, 90%, over 100%, the riskier you are and the more points you're going to be losing. So I have much experience in getting calls from irate consumers saying, I don't understand how the score could be so low. I have no missed payments. I pay all my bills as agreed. And usually the next question I ask them is, well, let's talk about how much debt you have. And so it turns out in 9 times out of 10 that they have made all their payments as agreed, so they're getting the positive points for that, but they sometimes have $100,000 in credit card debt. And so that is having a substantial impact on the score. So in this one, what's important to understand is, again, it's somewhat controllable in your hands. If you have reserves of extra money where you're able to pay down some of that additional credit card debt, that'll help. In terms of strategies, typically the score weighs more heavily revolving debt, so like credit card debt department store debt versus installment debt. So if you, let's say, get to your tax return and you got a return of $750 and you want to reduce your credit balances, you're probably going to get a bigger bang for your buck on the score by applying that incremental money to pay out on revolving trade lines versus installment trade lines like car loans and personal loans, etc. And then with credit cards, if you have multiple credit cards with balances, one strategy that may be beneficial is to pay down your lowest balance credit cards first, so that you are showing that you have less accounts and less credit card accounts with balances, as opposed to paying off or trying to pay down a large balance where it still would have a balance after you're done. But that all depends on your objectives in terms of if you're looking to pay off highest interest rate cards first. So again, the operation hub folks can look at your credit report and provide you with all the different options you have and which ones make the most sense. So right now we've covered the credit history, payment history, as well as outstanding debt, and those represent 65% of your score. So those are areas where you really want to focus when you're looking at your score and trying to figure out ways to improve it over time. The third category is what we call length of credit history. So lenders like to see consumers that have a long credit history paying as agreed. It shows stability and low risk behavior. So things we're looking at here is how long have you had your oldest account? So let's say you opened a Sears card 30 years ago. So that's providing good information about how long you've had credit history in terms of a single account. Probably what's more predictive and more heavily weighted is what we call the average time in file of your credit report. So let's say you have 10 credit accounts on your credit report. One of them is a Sears card that you opened 30 years ago, but the other 9 are credit cards and installment loans that you opened in the last year. So when we look at the average time in file across those 10 obligations, it's not as deep as the 30 years you have on the Sears card. So you get some points for having that 30-year history, but you're probably going to get less points for having a relatively short length of average credit history on file. So, the actions you can take with here is only apply for credit when absolutely needed, so that your length of credit history ages, and that'll help your score over time. So that's the way to try to address the third category here. The fourth category is what we call pursuit of new credit. And here we're looking at numbers and number of new accounts opened in the last year by the type of trade it is, like revolving versus installment. We've talked a lot about inquiries, but just a couple more points on those is, again, we're only looking at the inquiries posted in the last 12 months. And we have logic in the score that treats inquiries associated with rate shopping differently than a standalone inquiry. So if you go out this weekend to shop for a car and finance it, most likely the dealer is going to do what's called shotgunning your credit report to several different lenders they have a relationship with to get you the loan. And each of those lenders that have been shotgunned will pull your credit report and score to see what kind of financing they can provide the dealership. And so the model is smart enough to know, hey, Joe Smith is not applying for 6 car loans here. This is all associated with 1 car loan. So we have logic in the model which will group those similar inquiries for rate shopping and treat them as a single search for credit. And the same thing with mortgage. If any of you have ever gone through a mortgage escrow process, the lender will sometimes pull your credit report multiple times in that 30 to 45 day period from when you make the offer to when it actually goes to escrow to make sure that everything is good and not changing on your credit report. So for mortgage identified inquiries, we have what's called a bypass period where we look in the last 30 to 45 days and all inquiries that were related to mortgage or auto or student loan are bypassed and not counted to accommodate for that phenomenon. So again, I get a lot of calls from consumers who focus and obsess on the number of points lost due to inquiries. The advice I give them, as well as you, is to not focus on inquiries, but to focus in on paying bills on time, as well as on reducing debt. That's what's going to give your score the biggest boost. Then the last category is credit mix. So basically, what we find is that consumers that show they can manage different types of credit products successfully and paying on time are a little bit less risky than consumers who don't. So, you know, is the consumer able to show that they can manage revolving credit as well as installment credit? And so that's what's meant by credit mix. Again, this only represents 10% of the score. So again, it's one of the things that you should be aware of, but definitely not necessarily focus on as you're trying to improve your scoring. So hopefully you found that information helpful and demystified certain things about the credit score. You learned something new. Real quick, we'll just go into a quick review of credit score dynamics. So a lot of the information that I've been sharing with you is kind of educational in nature and kind of not applicable. It's applicable to real life, but hard to see. But this slide provides you a real life example of how having a higher FICO score has real benefits in terms of money savings. So this is a table, a loan savings calculator table that says, assume that you're applying for a $275,000 mortgage loan for 30-year fixed. And it lists a bunch of interest rates by FICO score tier. So the middle table you can see on step 3 shows that if you have lower FICO scores, your interest rate is going to be higher than if you have a higher FICO score. And then the table in step 4 says, if your current score is in that score range, and let's say your score is 650, what savings opportunities might you observe if you were to get your score up to 750 or 740, etc. And then it shows you the interest rate savings that would have been that could be realized with that movement of your score up to a higher tier. So as you can see that the savings in interest rate fees over the life of the loan can be close to $100,000 at the highest tier. And that's a lot of money, and it's real benefit in terms of having a higher FICO score. So if you're in the process of getting thinking about getting a mortgage loan or a car loan, etc., it pays to go out and play with these calculators to see how much you could potentially save if you are looking to increase your score in the near future, but be more attractive to lenders. And the last section before we switch over to Operation Hope is protecting your credit. So obviously with the coronavirus situation that we all had to deal with in the past several years, it impacted many people's ability to pay for credits or loss of job, etc. So if you find yourself financially impacted, not only by something like a pandemic, which is hopefully a once in a lifetime experience to be a part of, but if you live near an area that has, let's say, hurricanes or tornadoes and natural disasters that strike and they impact your ability to pay bills as agreed, or your living situation, increasing your expense, you got to let your lenders know. That's the number one message here is lenders have programs they've created for these kind of situations, and they want to help you, and they need to know and hear from you to be able to help you. So if you are in a situation where you're running into some type of obstacles due to things like natural disasters, etc., pick up the phone and call your lender, and they have programs that will help them. And two of the most common are what's called a forbearance or a deferred payment plan. So basically, these two programs will enable you to either reduce the amount of money that you have to pay for a certain time period, or allow you to defer payment. It's not a freebie; you'll have to make it up eventually, but they will usually work with you to do that. And The good news is being in one of these programs will not impact your FICO score negatively. They have certain codes that they report on the consumers that are in a forbearance or deferment payment plan, and our models will bypass that in terms of considering that to be negative. So again, it's in your best interest to reach out if you happen to find yourself in one of those situations. So I know this is a lot of information to sit through and take notes and stay focused on. So this slide, again, the decks will be available to you, provides a list of different resources that MyFICO and FICO has regarding credit education and scoring and how it all works. So I encourage you to take a look at these resources and use them. You'll find a lot of good information out there that can help you as you lay out the foundation for your score increase program. So what I'd like to do next is turn this over to Yolanda, who can provide you with information about the great services that Operation Hope has and that you should definitely consider taking advantage of. Yolanda, the floor is yours.
Thank you so much, Tom. Good evening, everyone. My name is Yolanda Butler, and I work at Operation Hope, and I've been there for 10 years in various capacities, and I am a financial well-being coach there. I want to share with you information about Operation Hope and how you can connect the dots with what Tom has said to you regarding your FICO score and the services of Operation Hope. Operation Hope has been in business for 31 years. I count that an honor to be a part of it. I've been a part for 10 years. So the first thing I want you to focus on is that Operation Hope has credibility. We've been doing this for 31 years. You're on this call because you're looking to find out more information about purchasing a home. We've coached people for 31 years in this area. I wasn't a part of Hope at that time, but I remember in my early years seeing where Operation Hope started. And we used to be on the Oprah Winfrey Show. Mr. Bryant used to be there and he was saying, no loans denied. And we are able to say no loans denied merely because we have competent and caring coaches. When I say competent, I'm actually speaking of the fact that we have coaches that have backgrounds in homeownership. Many of them have worked in various capacities of homeownership on our team. You can move to the next slide, Tom. Many of them have worked in various capacities of homeownership. Many have worked with credit. And so when you come to Operation Hope to work with us, we want to make sure that we are giving you current information, credible information. So what could you expect with a home ownership coach? We have an 8-hour HUD certified program. Let me say that again. We have an 8-hour HUD certified program. All of our services are no cost. When you meet with our HUD coaches and you go through the home ownership workshop program, and then if you choose to decide to work with a coach, we're going to get you ready in terms of being able to buy a home. It's more than just the FICO credit score. It's making sure that you meet the benchmarks and the milestones for home ownership. And our program also involves allowing you to be prepared to be a sustainable homeowner. We don't just want to see you have the credit score and then be able to qualify to buy a home, but we want to be able to look years down the road to see, as Keon said earlier, that you're building a legacy in your family for home ownership. Now, also when I say competent and caring, and we have a home ownership program, certified program, I want you to understand that if you choose to work with us, we have the capacity, and you can move to the next slide for that one. When I'm saying the capacity, not only are our coaches competent in the subject matter and they care, but our capacity in terms of how Operation Hope is built out, we're nationwide. So here are some of the choices that you will be able to make in terms of working with our team. We can work with you virtually, if that would be your choice. We can work with you in person. And merely to work with our team in person, you would need to go to our website. And I'm sure it's going to be information in the chat, but I'll just chat it out right now, www.operationhope.org, where you will be able to actually self-select a coach in your area if you chose to meet with someone in person. Also, our capacity is such that we not only work with people in English, but we have coaches that speak other languages. So if you're on this webinar today and you speak Spanish, you speak Asian Pacific, all other dialects, we have the capacity to be able to handle that. And so we're real excited to be a part of this. Some of the people that partner with Operation Hope, just so you understand who buys into what we do, we have corporations, we have philanthropic people, but most importantly, I'm impressed that the CEO and founder, Mr. Bryant, also pours money right back into this company to be able to offer the services that we have. So again, Operation Hope is credible. We've been around for 31 years. We're competent in our subject matter. We care. We want to see you succeed in homeownership and create that financial wealth. And we have the capacity to do so. And yeah, I'm just excited about this, and we look forward to working with you. Thank you so much, Tom.
Thanks, Yolanda. That's you guys do some great work there, and I hope everyone is able to take advantage of it. So, Jessica, I'll turn it over to you.
Great, thank you so much, Tom and Yolanda. Just a quick reminder, if you do have any questions for our speakers, please pop those into the Q&A box. You can click on that Q&A icon at the bottom of the screen, and your questions will queue up there. All right, let's see. Our first question is it possible to get a perfect credit score, and what is that number?
So the answer is yes. And for most of the FICO scores, that perfect number or perfect score is 850. However, the target goal of having a perfect score is, I guess, good for bragging rights, but that's about it. Because lenders do not require a perfect score to make a good credit decision. So for consumers who are scoring anywhere from, I'd say, 760 and higher, will typically be getting very attractive offers of credit based on their score. So you don't need an 850 to have to get good credit.
Great, thank you so much, Tom. Our next question for you is, I would like to subscribe to MyFICO's monthly credit monitoring with all 3 scores, but the cost is prohibitive. Does FICO ever run promotions that reduce the cost?
No, we do not run promotions that I'm aware of, but that's something that I can take back to the product team as feedback. And but you can get your free FICO score on MyFICO. It's the FICO Score 8 based on Equifax data. And then on Experian, you can get access to your free FICO score. It's the FICO Score 8 based on Experian data. So there are avenues out there to get access to your free score, but just not in a subscription service as you have requested.
I'd like to add one to that, Tom. You can actually go to www.creditchecktotal.com. Again, that's www.creditchecktotal.com. There you will be able to get all 3 FICO scores and your FICO report for $1. Now, just like Tom said, it is a subscription, So you would want to make sure that once you got that report or those reports that you canceled, and you would be able to do that by phone or you could do it by email. And from my experience, that's just a one-time thing. If you wanted to get that again, it's based on an email. So you would need to put in another email address to be able to get all three of those. www.creditchecktotal.com.
Great. Thank you so much, Yolanda. I have another question here. The question is, I have several credit cards with balances. What's the best strategy for paying them down?
So I think that's a perfect question for Yolanda, because you and your expertise and your team's expertise can look at that and come up with a plan.
Yeah, so, there are a couple of strategies. We probably want to look at your whole credit report, but let me just tell you some things to think about. Tom mentioned one of them in terms of how you pay the debt down in terms of avalanche, snowball, highest interest rate, but there's a balance transfer. Now, if you have a pretty decent credit score, and normally with the balance transfers, you want to be looking for the promotional periods. A lot of times it's a 0% interest rate. They'll give you a certain amount of time to be able to make these transfers. And that is one way, because what it will allow you to do is to bring down the utilization on a card. My caution would be this: when you're looking at a balance transfer, sometimes, because I've had this experience myself one time and I was pretty upset. I put in for a balance transfer and I only wanted to do $1,000, and the company gave me a card for $1,000. If you understand what that meant, that's 100% utilization that you're using. So that wasn't really good. And I tried to fight it, but it is what it was. Secondly, what you could do, you could actually, if you've had your credit card for a pretty good while, you could ask for a credit line increase. With a credit line increase, that would bring your utilization down, and it would allow you to pay down your card within your budget without trying to bring it down in chunks at a time. So those are two strategies you could consider.
Well, what a great session we just had. I want to thank our presenters, Tom and Yolanda. You both did an amazing job. We are getting to the end of the session now. And I also want to thank our awesome Operation Hope coaches who are answering questions in the Q&A. Hopefully everyone takes advantage of the opportunities that Operation Hope is offering. I also want to let you all know that we will be sending out a survey to get feedback on how we did and to get your thoughts about the session. So please be on the lookout for that, as we would greatly appreciate your feedback and your opinions. So, thank you everyone for joining us. We really enjoyed doing this session. Please be on the lookout for more of these. You can find more tips and information on our social media accounts. We are on Instagram at FICO Score Better Future, and Facebook, Twitter, and LinkedIn at FICO. And so thanks again for all of our speakers and all of our participants. We really appreciate it. Have a great evening, everyone.